Hello there, and welcome to the second episode of this kind, the second episode of Financial Deceptions, a series that I've started to cover information that I believe give the management the opportunity to present certain financial numbers better than they actually are, and kind of maybe mislead some of the investors into believing that a company is doing better than it actually is. And for this episode, I'd like to touch upon EBITDA and especially adjusted EBITDA. I'll start with the rationale and basically the thought process of Charlie Munger when he was referring to EBITDA as something that should be replaced with bullshit earnings. And his rationale was, why would you take a number before interest, tax, depreciation, amortization when these are very real economic expenses, right? So interest is cost on your debt. You have taxes, you have to pay them. Depreciation, amortization is something that it's not really a cash expense, but these are assets that sooner or later will need to be replaced. So as such, once you adjust for all kinds of expenses that are actually real expenses, the usefulness of this measure decreases. Now, there's the other side that argues that EBITDA is also a measure of operating cash flow to some extent, and it also captures what is within the control of the management. I don't fully agree with that, especially depreciation amortization is something that is based on their past decision. Interest is again based on maybe the interest rate is not depending is not something that they can influence, but the decision to finance through debt versus equity is something that has been decided by the management. And recently, of course, well, recently is maybe an understatement. This is a word that has been there before EBITDA, the word adjusted, for quite a while, and it gives the management even more freedom to adjust this number and to present better results than the reality. And every company in their annual report, in their quarterly reports, when they report this number, they also provide a definition how it is being calculated. So in the case of Lyft, and there will be two more examples, they calculate adjusted EBITDA as net loss. So basically, they start from the net loss adjusted for, and these first four bullet points is basically what you would adjust for if you want to get to EBITDA, right? So interest and taxes, depreciation, amortization. That would be the regular EBITDA. But then they continue with all the other bullet points: stock-based compensation, payroll tax expense related to stock-based compensation, claims, sublease income, and all of these other kind of stuff. And here the question comes: so once you adjust for all of this, what is the usefulness of this adjusted EBITDA as a measure? And I'll argue that it isn't really useful, and I don't look at it for this reason. Stock-based compensation and payroll tax expenses relate to that. I mean, this is a very real expense. If you already own a certain percentage of a certain company, the more stock-based compensation there is, well, your ownership decreases. And if the management and the employees who are receiving this kind of compensation were paid in cash, well, in that case, even though the net loss would have been same, the adjusted EBITDA would have been lower because there was nothing to adjust for. So they're adding back expenses in this case that, in my opinion, are real expenses. They're not cash related expenses directly, but why would you add them back? I don't understand the rationale for ignoring share-based or stock-based compensation. And of course, if you take a look at the impact of all of this, there's a reconciliation starting with net loss. So Lyft have been unprofitable every single year. 2022, 1.6 billion net loss. Once you adjust for all these smaller, relatively smaller amounts, then you get to stock-based compensation, 750 million. Basically, you wipe half of the loss when you're trying to adjust for it. And then this adjusted EBITDA, 470 million. So what can anyone do with this number? It's incomplete. It doesn't take a lot of, in my opinion, relevant expenses, but it allows the management to, for example, brag that they've reduced the adjusted EBITDA loss, right? So the not, it wouldn't be fair to say earnings. It's the negative EBITDA, but in half, right? Makes no, I cannot find a useful case for this number. If I take a look at Fiverr, this is a company that take a look at the net loss every quarter, a loss. some adjustments, right? These first 3 lines in this case relates to the 4 letters: interest, tax, depreciation, amortization. And then again, we have share-based compensation. And take a look at how significant these numbers are. They're so significant that actually they contribute to turning this net loss into positive adjusted EBITDA margin. 11%, 11.3 Q4 2022. But again, this number means absolutely nothing because you are paying not with, based on this number, with cash or with shares, but you're paying with shares, right? It's 10. These are. I never understood why it is being accepted and not really challenged. Because the presentation of this, again, it allows the management to present positive information, but it isn't really capturing all of the expenses. So the usefulness has decreased. It only allows for, in my opinion, just misleading those who are reading the information, unless they really understand what is this adjusted EBITDA. But if somebody already understands what adjusted EBITDA is, they won't be looking into it. So if we take a look at Palantir, loss from operations, let's take a look at the last 2 years, 2021, 2022, right? So the loss has decreased, but after adding stock-based compensation, right? So loss from operation, basically in here, they probably have already added depreciation, amortization, and I would not be surprised if they've added also definitely interest and taxes. But after they add stock-based compensation and taxes relate to that, suddenly they have a positive adjusted operating income of 31 and 22%. And these are significant numbers. So what is the usefulness of this? Not much. I don't see it, other than the management being able to create to some sort a positive story, some numbers that sound positive, that have positive sentiment around it. I just don't see the usefulness, and I understand fully why Charlie Munger would argue this is bullshit earnings. And the same goes, if you take a look at Palantir, they also have gross profit and then adjust for stock-based compensation related to probably employees that are directly contributing to that. And if you go all the way down, you can see the same for net income. They have adjusted net income. So all of these metrics are just metrics that allow the management to say something positive, even though the reality is that it's not so positive. Now, at the end of this video, what I want to touch upon is there are many content creators out there who use EBITDA or adjusted EBITDA even as a base for valuation, and they just apply a certain multiple to it. If you're aware of how misleading EBITDA or adjusted EBITDA can be, then you know that the whole valuation process is completely flawed, and applying a multiple to a base that is misleading leads to a valuation that can be misleading. That would be all regarding this video. I hope that you enjoyed it. If you have any questions and comments, let me know. And as always, I'll see you in the next one.